Hello everyone, how's it going? If you're looking to buy Palantir stock, then keep watching this video because we're going to look at the company's recent news, how the market has been treating the company, and what are the technicals telling us. We're also going to try to come up with the best trading approach given the current circumstances. As the market remains very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to comment, like, and subscribe to my channel. Over the past few days, Palantir has been trying to reach the $20 level as its price edges ever closer to this critical psychological level. There are a few occasions when it actually manages to do so, but so far, it's not sufficiently sustainable for the price to remain above this level. The company has made a move on the artificial intelligence narrative while it's still new and fresh in people's mind, in addition to its now positive profit margin. So far, the market has received these theses quite well, taking them as actual vectors by which there will be an increase of demand in that sector. The generative and large language models have been very popular over the past few months, as it is one of the first times when the public realizes the potential of artificial intelligence. These large models may likely require an analysis of a very large quantity of data, a domain in which Palantir feels right at home, and the market also believes that Palantir may be able to develop its own models and platforms thanks to the data it has, generating more revenue streams with the private and public commercial partners. In other words, it has an abundance of the raw materials and predictable demand. All it needs is the capacity to process what the market is looking for, and sky would no longer be a limit afterwards. Because after all, one of the key advantages of Palantir over many of its tech rivals is its relationships with large entities who have access to deep pockets and almost an unlimited quantity of resources. Now, there's also another factor to keep in mind, and that is the position Palantir is in the market's eyes. In their view, Palantir is a company that leads the way in terms of demand for tech stocks. If there's more appetite for risks, once again, Palantir would be one of the first stocks to benefit from this new context. So, with that being said, let's also take a look at the technicals. The trading volume of Palantir has recently been around 50 million shares compared to an average volume of 66 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $20.37. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there is enough liquidity to support a trading strategy. With a very thin float, it would be easy to influence the stock price around, but the same low liquidity could mean that the demand can be limited. When we compare the current volume against the average volume, there might be a possibility for a trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Palantir is currently around $43 billion, compared to an enterprise value of around $15 billion. As we compare the current price to the historical price fluctuations, the stock is around 37% higher than the 1-month low, 45% higher than the 3-month low, and 240% higher than the 52 weeks low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is 54%, compared to a historical volatility of 71%. The put-call volume ratio is currently around 63%. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is around 262,000 contracts a day versus the 30-day average of 307,000. In terms of open interest, the most recent volume of open interest is around 3.1 million contracts, compared to the 30-day average of 2.9 million contracts. In terms of the shareholder structure, institutional owners hold about 36% of the float. The biggest shareholders include Vanguard, Renaissance, and BlackRock. It's always a good sign to see some institutional participation in a stock. It offers a layer of stability and reliability in the medium to long-term perspectives. It means that the market is confident that it's going to deliver the value in the long term, an important factor to consider for investors. I personally consider that a minimum threshold should be around 25 to 30% of institutional involvement, although there are many exceptions to this rule, of course. There will always be great companies mostly owned by retail traders. The current short interest is around 8% of the total float, and 60% of the transactions are coming out of the dark pools. Typically, if the short interest is above 15% of the total volume, and that a significant portion of the short volume comes out of the dark pools, it may suggest that there are institutional positions taken to short the stock, and that there could be potentials for a short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains, and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. My recommendation for Palantir is to have an existing position first and then to slowly accumulate its shares over time. I believe that the timing at which Palantir may take off will coincide with the decrease of the interest rates. So we may still have a few months or even a few years ahead of us. Overall, it's a stock worth having in your portfolio, and I believe that it's going to blossom in the long term. The recommended commitment would be between 3 to 5% of your portfolio in batches of 20% at a time.